bring in Rob Lauzon for his take on equities. Before we get going, tech, where do you think this one ends?
I think it goes down the path of where management and the Keevil family wants it, where given their controlling stake, majority voting stake, you'll end up getting this coal spinoff, which, my first, gut feeling when I heard about the coal spinoff was, it's going to be good for ancillary businesses like West Shore, who moves that coal off the port, because I think once they've isolated it, it'll have, longevity. But where I think it's probably best placed is within private equity. So it's not publicly traded. It's going to have, it's met coal, so it's what's used to build buildings and steel. It's not thermal coal, which is burnt for electricity. However, it'll still be painted with that brush. So I think if it's off the stock exchange, not publicly traded, it's a cash cow. So I think private equity is the best spot for that. So that'll be interesting to whether they end up spinning it off or selling it to private equity before the spin-off. But I think tech as a Canadian miner, the way that it's been planned out is probably the way it stays. And I think Glencore is not successful.
One interesting governance thing I think here is, so they spin off the coal and say it gets taken over by private equity, but the coal operation is on the hook to pay vast amounts of cash flow to tech. And I wonder, would private equity owners of the coal company be happy with that? Would they just be stuck with it? Yeah,
I guess there would be some sort of agreement, repapered up, and the stream of cash flow is valuable to each party. So there's going to be a price for everything, and you might need to rewrite that if it's done prior to the spin-off, right? So, but yeah, no, it's front page news, something to watch here the next couple of weeks.
What's your view on the markets? Are we past the worst of the banking fears? I know it's very hard to predict. Anything could pop up at any time.
Yeah, I think we are, because of what the Fed has really done again. The Fed put is back for regional banks, where they will essentially, implicitly guarantee the deposits through these, mechanisms where they can put assets to the Fed, whether they're trading at 90 cents on the dollar, the Fed will give them par value for them. So the big risk near term is two things. One, earnings expectations, because deposits have come out of banks in the U.S. in particular, where they were just sitting there earning less than 1%. And this front page news on the crisis has, woke people up to say, well, I could actually take that $17,000 I've got earning nothing and move 15 of it into a money market fund earning 4%. So that is actual deposit outflow out of these banks. So that could hurt loan velocity and earnings. Second is just, what's the new regulatory regime for banks? Is there going to be a cap on dividends being able to be paid by regional banks? So the chairs might move around here for the rules, and we've kind of stepped to the side to watch, and we'll get back in at some point. So right now, the safer places to be are the large banks that are reporting at the end of this week. JP Morgan, next week we'll get Morgan Stanley. Those type of names, should benefit from what we've seen here in the last month.
We're looking forward to it. Rob Lauzon is here. He's taking your questions today on dividend stocks. I should ask, U.S. and Canadian dividend stocks? Okay, but not stocks that don't pay dividends.
Well, we could chat about them. I just kind of wanted a focus call, but I can take calls on those if need be.
For sure. Yeah. Okay, but dividends always fascinating. So we'll be right back with Rob. The number to call right now, 1-855-326-6266. We have an email from Faisal, curious about Freeport McMoran, the giant miner, copper, gold. What's your view over the short and long term?
Yeah, this is a great stock to own for copper. It's the largest publicly traded copper producer, pure play. Copper is going to be a metal that's going to be in high demand over the next, 2 decades. Not only for batteries, within electric vehicle charging stations, it's used in transmission grids. So it's the electrification concept, copper definitely has a tailwind there. So it's just Freeport will trade with copper prices. So when copper gets over 4, usually interest comes back into that commodity, and it'll trade on the downside with recession fears, right? So I've always found, the low. You've got a floor, I think, on Freeport in the low 30s, but I think for shorter, medium term, you for sure should have mining or some materials in your portfolio. This is an excellent choice. The dividend's a little light at 1%, but perhaps they'll be growing that. So I would recommend owning about half now that it's kind of pulled back a little bit over the last week or so, and then just wait to see if we get during this earnings season, do we get one more pullback in the market here, which should bring the stock back to like 35 or so, and you've got your position. But for your question, then you hold that for the next 10 years, and it's going to go up and down like any commodity stock. But I think you've got an attractive entry point, and it's you'll have the opportunity to trade out of it if you choose to in the 40s in bullish copper environments. So yeah, definitely it's one that we're looking at currently to get on dips.
John sent us an email, wants to know about Synovus.
Yeah, so I think of Synovus as really an oil play. They do have some natural gas internationally, but so you got to pick your horse for oil. Synovus is the cheapest senior when you look at oil stocks like Suncor, CNQ, Imperial Oil, but it's cheap for a reason. Trades a multiple point cheaper than the group because it hasn't executed well.
Synovus.
Yeah, it's kind of stumbled. Even their last quarter was a bit off estimates. So I think, I think if you're personally, if I was going to choose an oil stock, if you want to stay senior, you're probably looking at a pure play. Oil would be Suncor I would choose over Synovus at this point. We prefer the mid caps right now that pay dividends, like a Headwater or a Whitecap. Those two I would choose over Synovus at this point. But yeah, it's just, all boats will lift in a higher oil environment. But I would choose, either Suncor if you want something super large cap, or the other two names that I mentioned.
Okay. We have Mark on the line from Ottawa. Go ahead, Mark, please.
Well, thanks, Andy. I'd like to ask your guest about Boston Scientific. I like this stock, but it's just making me nervous right now. Maybe I should just take my money and run with it, and maybe invest in TMO. What are your thoughts on this? Because the valuation is just extreme. Thank you.
Thank you.
We like Boston Scientific. It's had a good bounce here throughout the beginning of this year. As you can see from that chart there, Mark, it's kind of struggled last year. One of my top picks today is in the same category, MedTech. So you can perhaps look at that as an alternative. Thermo Fisher, TMO that you mentioned is another great one. We own Boston Scientific. We like it. It's the leader, so it trades at a premium multiple for a reason. So, MedTech really has struggled and lagged pharmaceuticals. When you look at the overall healthcare sector, it's been pharma that has led it over the last year and a half. And I think this year, MedTech is going to be the next 18 months. MedTech's where you want to have some exposure. So I'd be okay with you holding it. Depending on your tax situation, you could trim a bit and add to my name that you'll get later on in the show. But we like it.
Mavis in Burnaby, BC. Go ahead, Mavis, please.
Thanks for taking my call. What's your opinion for IGM? I collect dividend from them. Now they have sold the investment to Canada Life and bought Rockefeller. Will I be getting a dividend from IGM when they bought Rockefeller? What should one do when one owns IGM for income dividend?
Thank you.
Hey, Mavis. Yeah, I think you're fine with the dividend. They're still going to pay one. It's, a lot of AUM of Canadian investors are within the IGM group. It's pulled back here, as many companies do when they do acquisitions, spend capital on integrating a new company that comes with risk, and they're expanding into the United States. So that comes with risk. It peaked its head over $45. It's pulled back to that kind of high 30 range, which is I think where the stock kind of flatlines here for a bit. So it's definitely one that I wouldn't be shy of holding here. You're not gonna go wrong with that. If you wanted some other ideas, you could go up to their parent, Power Corp, POW, and just go up the ladder that owned pieces of all of these companies, Great-West Life, Investors Group, and just switch into the parent, POW, which I think has a approximate 4% dividend yield if you're looking for yield. So that could be an idea for you. But we'd be a hold right now on IGM.
JC is on the line from North Bay, Ontario. Go ahead, JC.
Hi, can I ask about Tidewater Midstream? It's pulled back a little bit. Do you think it's a good entry here?
Hey, JC. Yeah, I do think it's a good entry. It would be a high-risk stock. It owns a subsidiary called Tidewater Renewable that had about a $50 million cost overrun on the renewable diesel plant. So they got to fund that. So there's a bit of a funding issue with Tidewater Renewable that Tidewater, the parent, the one that we're talking about here, TWM, owns. So I'd call it high risk, but I think at 90 cents here where it's trading, there's implicit value in the stock. The CEO left last year unexpectedly, so we've got a new CEO, which I would describe listening to him on their last conference call about a month ago as trying to strategically rework the assets. So I think there's some valuable hard assets here that are worth definitely more than 90 cents per share. There's some debt here, but I think the stock's probably worth $1.20, $1.30. So it's high risk, but I do like the entry point here.
So you were talking about Tidewater Midstream.
Yeah,
there.
TWM.
Yeah. Do you have any views on Tidewater Renewable? Because that has been struggling as far as I know.
Yeah, so the main theme there with LCFS is the symbol is they've got to get this refinery producing renewable diesel for British Columbia. And the government has their backing. They want renewable diesel. They want cleaner fuel in British Columbia. So that's a very valuable asset. But we're not going to know probably until August, sometime in the summer, whether the facility works. That's about 97% done. So they've got to test it, do some commissioning, and flick the switch. So that could be a great catalyst for this story sometime here in the summer, and very valuable because everyone's looking to become more clean. And if you can show that you're buying renewable diesel or producing it, it's a strategic asset for someone. So it's, again, high risk, but high reward too, potentially.
Philip is calling from Montreal. Go ahead, please.
Good day, guys. I want to ask your guest about TD Bank. I know they're having their issues because of the U.S. banking situation, but would this be a good entry point for a senior's income portfolio? Thank you.
Thanks.
Yeah, TD has really pulled back here. I'll just say $10 a share. So you've got a great entry point if you're looking for income and, just put it away. You typically have been rewarded buying banks when they pull back. And as you stated, they're under pressure here a little bit and there's a lot of shorts on the stock because they had to close on an acquisition in the U.S. And we'll see over the next month, hopefully, whether they are able to rework a little bit of a lower price for it. But the price that they're paying for it is a lot higher than they should pay given where regional banks are trading. So there's noise on the stock, but that's why the shares are down, $10 here very quickly here in the last month. So, we like it. We like Royal Bank. We like National Bank, but we do own some TD here as well. So it would be a good entry point for a company that typically grows their dividend. And if you can get a bank with a pretty good yield and going to grow that yield for you, that's good for seniors to fight inflation if their quarterly check from their dividend portfolio is going up.
One thing you're watching here is commercial real estate, because we just don't know how much damage there's going to be in the office sector. I know this doesn't just apply to TD, but could that be a big problem for the banking sector?
Yeah, that's another. I could have talked about that at the top of the show as well on the regional banks in the States. The regional banks are 50% of lending towards commercial real estate, which is like $4 trillion worth of loans. There's about 10% of that coming due this year. And in 2024, there's about, I think, $1 trillion of that amount of debt coming due. So there's refinancing risk. And if you got a loan on a building that's only 50% full because it's not the best office tower and people are not fully coming back to work, that's going to be tough to extend. So there's further, I guess, hair on the U.S. regional banking system because of that. So again, it's and that's why that whole group has been under pressure here. So that's another thing we're watching. The Canadian banks and the Canadian real estate sector is much more insulated. The amount that our banks lend to office is 3% of their loan book. So you're okay there with Canadian banks. And then our REITs, one of my top picks today is a REIT because they've all been taken down because of how U.S. shopping malls and U.S. office REITs have been trading. But you're comparing apples and oranges, so it represents a pretty good opportunity here for Canadian REITs.
Rob was on our show on May 10th of last year. Topaz Energy, the spin-off from Tourmaline, was his first idea. This one down over the period. Would they be very tied to the natural gas price?
They're tied to the energy sector in general, a little more to natural gas, even though they earn royalties off oil and gas, but they have a lot of exposure to oil. So. It's what you just see there on that chart, since December, coming in a warm winter when gas prices imploded, you can say, yeah, it's trading really correlated with negative gas prices, which is a buying opportunity. The company has 20% infrastructure. They've got exposure to companies like Headwater, Whitecap, and Tamarack, which are oil producers. They get royalties from them. So this is It would have been a top pick again if given how much it's pulled back, if I didn't have it as one the last time. So anyone listening, looking, for income, part of their retirement, the yield on Topaz is 6.5%, and they plan on growing it every year. And they've got a parent, Tourmaline, their major royalty. Who they get royalties from, growing at a rapid rate. So it's a real good pathway here for this company. So I would encourage anyone that bought it, last year before the bear market started in the 20s when I had it as a top pick to average down here below $20.
Your next idea was George Weston. I haven't checked lately, but I'm guessing nearly all the value of George Weston is the Loblaw stake.
Yeah, most of the Loblaws, and there's a fair amount in Choice Properties, which is the REIT that owns the Loblaw stores, and it also owns some industrial properties. So we really like George Weston. I traded out of it. It trades like a staple, like a Loblaw. So I traded out of it when I got a little more interested in a couple stock ideas. It's performed quite well. Hopefully listeners have kept it because it did exactly what it was supposed to do, give them a dull, boring consumer staple type of story. And this is one that the NAV on the company is $200 a share. So it still trades below some of the parts of its Loblaw shares. So down at $150 was really good opportunity. Here at 180, maybe a trim half if you're listening, and look for some other ideas. But it's a great story.
And finally, Cargojet. This one has been struggling. I have read that a lot of capacity has been added in the global or the international air cargo industry.
Yeah, and they've pulled back their expansion plans internationally, but the stock's been under a lot of pressure for that reason. The capacity worldwide increasing, catching up. The e-commerce boom everyone built, and then there was now too much supply.
Yeah, a bit like Amazon building too many warehouses.
Exactly, the same trend. So if you overlay Amazon stock to Cargojet, it's very similar. That represents a really good opportunity as a result. So the main reason I like Cargojet is they basically have a monopoly in Canada on the overnight cargo. So if I need to get something from Montreal or Toronto to Vancouver or Calgary overnight, you call Cargojet. And I know Air Canada and WestJet's thinking about getting some of that back into the bellies of their passengers. But all of the delays that we're seeing at Pearson, if you need it there in the morning at a certain time, or you need it to be there at 10 p.m. to get on a truck, you could do that with Cargojet because that's what they do for a business. Here, if you've got a delay or a passenger and you're in the belly of that, if your article is in the belly of that, it's just not as robust of a model. So I really like Cargojet down here, and I'm thinking about adding to my position here below. Well, it's like $110 a share, so it's a really attractive stock here. Yes. And, if I would have recommended Amazon at the same time, last year in May before the market collapsed, you would have had that probably same 40%, 30% down, or even worse. So, both Cargojet, Amazon, both those stocks actually look like good ideas right now.
Okay, let's take a break. Rob Lauzon of Middlefield Capital is taking your questions on North American dividend equities. Let's head to Vaughan, Ontario. Henry, go ahead, please.
I'd like to ask about U.S. company Energy Transfer, symbol is ET. It pays over a 9% dividend in U.S. dollars. What do you think about it? Thank you.
It's a big pipeline company, is it?
Yeah, it's a limited partnership. Typically, the LPs were drop downs from a larger company, and at one point, Enbridge had Enbridge Income Fund that traded in Canada, so it dropped down assets. Another similar, just for viewers, TransAlta. It's power, not natural gas pipelines, but it dropped down a company called TransAlta Renewables. So they dropped. So the parent develops, and once it's cash flowing and stable, it drops it down. I wouldn't expect much growth out of ET. So you're looking at, really like a long bond. It'll trade like a long bond, and then you'll get your 9% a year. And it's probably fairly stable as long as the throughput's there. So the risk is in a higher rate environment. I don't know its debt stack. We don't own it, but in a higher rate environment, as they roll their debt, that's a higher cost, and their margins will get squeezed. So I would rather own pipelines in the States. One that I've looked at, I don't own it currently, is Williams, or I would look at Enbridge or TransCanada, TC Energy in Canada that have operations across North America, because you get income and growth and control of their growth pipeline. So, these companies like Enbridge and TransCanada are yielding close to 7%, plus they're growing at 3 to 6% a year. So, you can get a similar total return to ET with controlling more of your, growth profile. So that's how I would play it. I would transfer it into Enbridge at these levels.
Okay. We have Phil on the line from Crystal Beach, Ontario. Go ahead, Phil, please.
Hi, Mr. Lauzon. I'm a mid-60s investor of both with fully funded RSPs, and I've held for the last 20 years a lot of the Dividend Aristocrats stocks in Canada, like an Enbridge and the big three banks. And so I've enjoyed the ride up, but I'm looking at this current pullback both in Canada and the United States. Is this a good time to take a lot of the Canadian-dominated aristocrats and switch them to the U.S. and since it's a more vibrant and dynamic market? Now I have a 15-year window on this.
I just love the fortress around our Canadian banks. So I would have a blend of both. And so I would probably continue to hold, a couple Canadian banks. And if these are inside your RSP and you're not taxable, then you can trim some of them. But as I mentioned before, we really like Royal and National Bank. And then moving to the States, I would blend in, Goldman Sachs, Bank of America, probably Morgan Stanley and Goldman Sachs would be where I would start. Goldman Sachs gives you exposure more to trading and equity capital markets. And I do think 2024 is going to be a better year for the stock market. So you've got that coming where you've got, IPOs, mergers and acquisitions, et cetera. So Wells Fargo, another one on the screen now. All of those can complement maybe National Bank and Royal. And then you've got, the leaders of both the U.S. and Canada and do that. I would still, just because you're getting higher dividends out of the Canadian banks, I think that's, whether you put those on drips or not, those are still pretty powerful tools to complement a little bit lower dividends out of the ones in the States.
Let's head to Scarborough. Nazar, go ahead, please.
Hi, Andy. Hi, Rob.
Hi.
May I have your thoughts on freehold royalty? It pays a good dividend, or would you rather own a producer like Whitecap Resources, which also pays a good dividend? Thank you for taking my call.
Yeah, so depending on your risk levels, if you're a lower risk investor, but you want exposure to energy, then you own the royalty companies like Freehold and Topaz, which I talked about in my past picks. You could also put in a pipeline company like Enbridge. If you want to move up higher in the risk stack, because an oil producer could, screw up a well that they're drilling, but also are at more of the whim of the commodity price, then I would go to a Whitecap, a Headwater, an Arc Energy. So you've got two pockets there, but Freehold, Topaz, you're getting high yields of 7%, 6%, and you still get exposure to commodity upside and downside, but at a lower pace. So if you're a little bit lower risk investor, just stick to Freehold. We own it, and Topaz. Buy them both.
Let's head to Wasaga Beach, Ontario. Go ahead, please, Mark.
Yes, good afternoon, gentlemen. I'd like to know if it's a good time to buy TC now, and the dividends, how are they? Are they going to be safe? And what's the stock price going to be in a few years? Thank you very much.
Okay, so you indicated that you thought the Canadian pipelines were a reasonable buy?
Yeah, once the overhang of their pipeline that they're expanding to get gas to the West Coast, that cost overruns have been enormous there, and that's why investors have punished the stock. We think the cost overruns are behind them, and the stock will get back to the low 60s once that's behind us sometime next year. That's our view. So it's a really good entry point here, in our opinion. If you can get it, in the low 54, 55 bucks, like it's already bounced from 51 where there was peak pessimism. So, think about $60 as the value where this thing should be trading, I think. So good entry point.
Dario's in Mississauga, Ontario. Go ahead, Dario, please.
Good afternoon, gentlemen. My question is regarding Agnico Eagle Mines. I just want to know your opinion on that. Thank you.
Yeah, it's, why do you need to own it? You're only going to own it if you think gold prices are going to go up, because that's what they do, right? So, gold to us is just like a haven trade where if you need safety, either buy Procter & Gamble or gold. With a mine, now this is a large company now with its Kirkland Lake purchase, so this company probably never gets taken over, in my opinion, so it probably is, now you've just got mine risk that they can execute. And so if you're buying it for gold, if you think gold is going to 2,500 an ounce, then just buy gold or buy an ETF on gold. I try to stay away from the gold miners. If I play gold, I buy the royalty companies like Franco-Nevada, for example.
Okay, you like the royalty, just more predictable?
Because I don't really have a reason to own gold, right? It doesn't make anything. It doesn't grow in value from an earning standpoint. It's a bet on safety, and I have other ways that I can have safety in my portfolio. I can hold cash and earn a return. I can, hold George Weston, which we talked about. There's other places that I can hold. And there was a trade here on gold for 1,600 to get it to 1,900, but we're through that. So now I'm just not sure where gold goes from here. So I'm not that enamored on the large caps here.
Okay, thanks very much for that question. Let's head to Trenton, Ontario, with its military tradition. Brian, go ahead, please.
Oh, good morning. My question is on Superior Plus. I've owned it for about 3 months, and I'll listen to you and see if I should still hold it, buy more, or get out. Thank you very much.
Well, they've made a big acquisition, which is, what was exciting when they announced it, to get a little more cleaner fuels into the business. I think that's a good long-term strategy. They're just going through an air pocket now where propane prices are high. Demand was low during the winter because of the warmer temperatures. So I think it's fine. I think Euro pays a good dividend. I think we don't own it currently. But I think it's one to look at now that it's pulled back in price here. So.
Okay, we have Lawrence in London, Ontario. Go ahead, Lawrence, please.
Good afternoon, and thank you for your past picks. I'm wondering if I should keep Pfizer or switch it and buy one of the other drug companies. Thank you.
Yeah, Pfizer, we've trimmed a lot over the last year once the COVID hype came out of the stock. And that's, as you can see this year, I think company analysts have realized the big drop in earnings that Pfizer will have because it doesn't have the big wave of COVID drugs year over year. In the low 40s, it represents pretty good value again. So you might want to trim half. I don't know how big it is. Just because it's pulled back so much, you're probably okay here at $40. Our favorite drug companies, just to name a few, would be Lilly or Merck, if you wanted to switch half into those. But Pfizer's valuation is quite attractive again here. So.
Okay. That actually reminded me, I was looking at a thing on Pfizer's website about vaccines, and it's called the 6 types of vaccine technologies, and it gets into the RNA and DNA, needless to say. We'll squeeze in at least one more caller. Bill in Allison, Ontario, please go ahead.
Thank you for taking my call. Long-time investor, but first-time caller.
Good stuff. Thanks for calling, Bill.
My question for Rob has to do with his own product, ENS, Enbridge Split. I'm wondering how much of the distribution roughly pertains to option plays, you know?
Yeah, we have the ability to write covered calls to enhance the yield on the dividends that we get from Enbridge. We do that from time to time. Our annual report just came out at the end of March there, so you'll see it's quite small given our bullish stance on the company, but we do write covered calls from time to time. So I think if you saw the stock get back to the $60 level, where we think fair value is, then you might see more covered call running to enhance the premiums and the yield that we get to give to you as a shareholder.
Okay, and so yeah, I don't think so Enbridge Split, and what is the idea with that one?
It's
Enbridge
an
Split,
enhanced,
how does that work?
Yeah, so it's a corporation. Symbol is ENS, is the capital share, and there's also a preferred share. So we created it for enhanced income and enhanced capital appreciation, 2 different securities.
Right.
So the corporation just owns Enbridge shares, and then we've created 2 securities out of that.
Yes.
One for ultra-safe preferred shareholders that just earns an income, and then the other shareholders get a levered return on Enbridge performance. So a little more risk there, but higher return potential.
Just to close something off, the leaked documents apparently claim pro-Russian hackers say they targeted Canada's gas pipeline infrastructure, but Enbridge has told Tara Weber, our Western Bureau chief, we were not attacked or compromised, and we have a robust defense program in place. The first idea is that big medical equipment company, Medtronic. Why do you like these guys?
I think it's a turnaround story. I think they'll be able to beat and raise, and those are the type of stocks we like that come out with earnings, guide higher. Usually the stock trends higher, and it's gone through a real rough 18 months here. It's a global medical device company. They're involved in some pretty like the growth areas you want to be in: cardiovascular, diabetes, neuroscience, but because of COVID, because of inflation, because of supply chains, those were 3 headwinds for them to try to manage their global business. And they missed their earnings last year, every single quarter. Their last quarter they came out with at the end of last year, finally was an inflection point, we thought, and that's why I'm prepared to come up here and say last year's dog, give it 18 months, but I think it's very similar to Boston Scientific. It just trades 2 multiple points cheaper. It's got a growing dividend, 3.5%, things that we like. And as you can see, 16 holds on the street. So not everyone's on the story yet. So we like it. And it's a good alternative for someone looking for healthcare in their portfolio.
Let's check out your next idea. It's the nat gas giant, Tourmaline.
Yeah, so we met with them last week in Toronto. They were here for an investor update, and I came away, more convinced than ever of their story, their 75 years of inventory. It's not all booked right now, but they've just got a massive amount of inventory. And when you heard ExxonMobil, the rumor this morning to buy Pioneer, that's what they're after. Inventory. And look at that stock price. Here's Canadian's largest natural gas producer in Canada, 4th largest conventional liquid producer in Canada, owns most of its infrastructure, and the stock's down $25 this year. So it's on sale. We think they'll give you a total dividend. They pay out specials of approximately $5 this year. So you're almost getting a 9% yield on a stock that I think is too cheap by $20.
Counting this special dividends or buybacks? Sorry.
The special dividends about 2%.
Oh, yeah.
And we think they'll give you about 7%, so 9% in total of income back to you,
including
in dividends. They don't do many buybacks.
Oh, I'm sorry.
They might do some if their stock got really. It's mostly dividends.
Okay.
And but I think the stock's $20 too cheap here. It was $55 all last week, so I think it should be in the $75 range. And I think nat gas, this will have a better outlook, especially in 2025, because that's when LNG Canada comes on, which will be bringing 10% of our gas overseas. So the story looks really good here, a really attractive entry point for viewers.
And presumably, Tourmaline is popular with investors over the long term. If gas does move up, it'll be a first port of call for a lot of people.
Yeah, it's 20 billion market cap, so it's very liquid. People go to it, and people have just exited the gas trade. Everyone's on oil, so it's been put aside. Look at the chart; it'll be back. Just give it time. Be patient with it, but you'll make money on it if you buy it here.
And then finally, Granite Reach. They're big in those warehouses, logistics, industrial properties.
Yeah, so we talked about Cargojet and Amazon earlier. This is really the building that they, would think of the buildings when you go to the airport all around there. And, net asset value on Granite's close to $100. So it's trading at about a 15% discount to NAV. That's always a good entry point on REITs. What I like about it, it's 99% occupied. And 80% of their leases in 2023, they just renewed at a 20% lift in rent. So earnings should go up 7% this year. It's been taken out with all REITs, and we think it's a good entry point of a real high quality REIT here in Canada. And it's a way to get global exposure. They've got buildings and e-commerce and distribution centers in the States, Europe, and Canada. So it's a way to get global real estate exposure by buying something on the Toronto Stock Exchange.
I'm not sure if we could put up a one-year chart for Prologis. I mean, they're the giant one in the States, right. PLD in New York. Is there a fear, though, people will decide, well, the momentum's gone out of that whole e-commerce infrastructure?
It's coming back because we've got onshoring. We got to store stuff. So you want to build chip plants, you want to build EV and battery plants, and they're building a big one in Windsor, Ontario. Well, you just can't, LG and Stellantis just can't put up an electric battery plant without then saying, well, we need land and we need places to store everything. And usually with that comes with jobs, which it's just an economic boom. So that's the new trend for these industrial stocks, is the onshoring that's going to happen here in North America for the next 5 to 10 years. So the trend's still there, and we do like the industrial REITs and Granite in particular.
Are you picking at any of the office REITs right now, or do you think it's too uncertain?
I think we have about 1% in our REIT fund. 1% of the 100% is office. It's probably Allied Properties. So it's just something we're waiting and seeing. There's no tailwinds on it right now. So there's no need to be a hero in office when you've got apartments and industrial REITs doing the heavy lifting and working for you. So.
I wonder what will happen, because from what I've seen, older buildings may be in trouble, the older
It's
office
all the B.
buildings.
If you have, like, we're moving to the Well, a new building in Toronto, a new office building.
Where the Globe used to be.
And that'll be the premier office building in Toronto. And there's where CIBC is moving there. But it's the B ones that the B quality are going to be totally empty, and everyone's going to want to be in the A buildings. So it's all about the postage stamp. It's the best building will be full and will attract people, especially the developments that have residential attached to office. Because you've got 100,000 people living in condos next to the office. It's going to be busy. So you have retail. So that idea works. If it's just standalone office off the 401, getting off on Huron, Ontario, if Pfizer decides to move out, who needs that spot? That's the risk in office. And luckily for Canadian REITs, there's not a lot of exposure to that type of office. So
that's interesting. Yeah, an office block just standing in the middle of nowhere kind of thing. Yeah, Rob, great stuff. Thanks very much. Rob Lauzon.